Ever wondered what really changed after those massive corporate scandals, like Enron and WorldCom? How do we ensure the numbers we see from big companies are actually, well, true? Welcome back to the deep dive. Today, we're taking a shortcut kind of through the complex world of ethical and independence requirements for auditors. Our mission for this deep dive is really to unravel the Sarbanes-Oxley Act, SOX as it's known, and explore how it fundamentally reshaped corporate accountability. Hopefully, you'll walk away with a clear, digestible understanding of these critical rules that, truly keep our financial markets honest. So let's unpack this. Before we dive into the specific rules, it's essential to grasp why such a monumental law came into being. What was the catalyst for this massive overhaul in corporate governance?
That's absolutely the right place to start. If we look back, the financial landscape in the early 2000s, or there was a profound crisis of confidence. We saw these spectacular implosions of corporate giants, Enron, WorldCom, and then widespread restatements of financial statements by lots of other companies reporting to the SEC. This wasn't just, a few bad apples. It really signaled a systemic breakdown in trust when it came to financial reporting.
A real crisis.
Definitely. So in response, Congress enacted the Sarbanes-Oxley Act in 2002. Its main purpose was a pretty fundamental shift to drastically improve the accuracy, the reliability of financial information disclosed by public companies. It truly expanded requirements for both financial reporting and auditing. The aim was restoring public and investor faith. It wasn't just tweaking regulations, it was a serious recalibration of who holds the financial truth.
Okay, so the financial world was in disarray. Congress steps in decisively. And the first major move was creating this completely new entity, the PCAOB. What exactly is this board, and what powers did it get to prevent future financial disasters?
Yeah, what's really groundbreaking here is how quickly they set up this dedicated oversight body. Title I of SOX created the Public Company Accounting Oversight Board, or PCAOB. And this board is quite unique in its makeup. It has 5 members. 2 have to be CPAs, certified public accountants, but crucially 3 cannot be CPAs.
Oh, interesting. Why the mix?
Well, it ensures a broader perspective, moving beyond just the accounting profession itself. And the PCAOB operates under the direct oversight of the SEC, the Securities and Exchange Commission, which is the main federal regulator for securities markets.
Got it. So what are its main jobs?
Its core duties are pretty varied. First, it registers public accounting firms, the ones preparing audit reports for public companies, what we call SEC issuers. Think of it like a strict licensing system. Second, it establishes the actual rules and standards for how these audit reports get prepared. And third, it has pretty robust powers to conduct inspections, investigations, and disciplinary proceedings against any registered firm that doesn't meet its standards.
So it's not just a registration body, it's an active watchdog with real authority. What does that ongoing oversight actually look like?
Exactly, and it definitely has teeth. The PCAOB has very specific inspection requirements. For instance, firms auditing more than 100 SEC issuers have to be inspected every single year.
Annually, wow.
Yep. For smaller firms auditing 100 or fewer issuers, inspections are still mandatory, but it's at least once every 3 years. This continuous oversight isn't just a formality. It really embodies a critical shift from a trust us model to more of a we verify everything approach.
Yeah.
It fundamentally altered the auditor's relationship with public confidence.
So if you're not registered with the PCAOB, you simply cannot perform audits for SEC issuers. It's basic entry now. And what kind of information does a firm need to provide in its annual registration? Is it complex?
Well, it's definitely not a quick checkbox thing. Firms submit a highly detailed annual application. They disclose everything from the names of all the public companies they've audited, the fees they received, to their internal quality control policies, any ongoing legal or disciplinary stuff. They even have to disclose accounting disagreements that came up between the audited company and the firm.
Really? Disagreements too?
Absolutely. And crucially, every registered firm has to consent to fully cooperate with any PCAOB request for information or testimony. Full cooperation. And beyond just registering firms, the PCAOB also moved pretty fast to standardize how audits were done. For example, audit documentation, the work papers now, must be kept for 7 years. And failing to retain these papers can lead to serious consequences, even criminal penalties.
7 years.
They also require a concurring or second partner review for every audit report. That adds another layer of scrutiny, quality assurance. And the audit reports themselves now have to describe the scope of testing on the company's internal control structure and procedures. It really emphasizes the importance of those controls. Registered firms also have to maintain robust quality control standards, monitoring ethics and independence from clients, and properly supervising all of the audit work.
And if a firm or an individual doesn't play by these new rules, what happens then? This is where the seriousness of SOX really hits home, right?
Absolutely. The PCAOB has the power to conduct thorough investigations into any suspected wrongdoing by registered firms or people associated with them. If they find a violation of SOX, PCAOB rules, securities laws, the sanctions are designed to be severe. They can range from temporary suspension to permanently revoking PCAOB registration, or even a temporary or permanent ban from associating with any registered firm. They can also limit a firm's or person's activities.
So potentially career-ending consequences.
Potentially, yes. And the civil monetary penalties are substantial. We're talking millions for firms, hundreds of thousands for individuals. It sends a clear message. Violations come with a very steep financial cost. Beyond money, the PCAOB can issue public censures, require professional education or training, or impose basically any other sanction it deems appropriate. The goal isn't just punishment, really. It's about ensuring accountability, deterring future misconduct, and ultimately rebuilding and maintaining that public trust.
Okay, so the PCAOB is the big enforcer, making sure auditors are registered, follow standards, and face serious penalties if they don't. But at the heart of reliable financial reporting is independence. If an auditor isn't truly independent, can we really trust their work? How did SOX Title II tackle that crucial principle?
That's the fundamental question, isn't it? And Title II of SOX really enshrines this core principle. To maintain auditor independence, a registered public accounting firm doing audits for SEC issuers simply cannot provide certain other services to that same audit client. It's all designed to prevent conflicts of interest where the auditor might end up auditing their own prior work or acting like management for the client or just getting too close financially.
Makes sense. What kind of services are we talking about?
Well, SOX Title II explicitly prohibits a specific list of non-audit services. These include things like bookkeeping, designing, and implementing financial information systems, also appraisal and valuation services, or providing internal audit outsourcing services. The idea is to keep the auditor's role purely focused on the audit itself, free from anything that could compromise their objectivity.
That's a pretty strict list. But what about tax services? Auditors often do a lot of tax work. Did SOX draw a clear line there, or was it more nuanced?
That's a great point and a common question. Tax services are permissible under SOX, but there's a catch. They have to be pre-approved by the company's audit committee.
Ah, so there's a gatekeeper.
Exactly. It creates an important safeguard, making sure the client's own independent oversight body agrees to these specific services. Another critical mechanism to prevent, undue familiarity and ensure fresh perspectives is audit partner rotation. The lead audit or coordinating partner and the reviewing partner, they have to rotate off the audit engagement every 5 years.
5 years on then off.
Right. It ensures a fresh set of eyes, looks at the company's financials periodically. And the PCAOB also requires auditors to disclose the name of the engagement partner in their audit reports. Transparency again.
Okay. And what about communication with the audit committee?
Beyond limiting services and rotating partners, SOX Title II also mandates specific reporting to audit committees. All auditing services, plus any permissible non-audit services like those task ones, must be pre-approved by the audit committee. That reinforces their central oversight role. Registered firms also have to report specific, critical items to these committees. This includes detailing the critical accounting policies and practices the company uses, discussing any alternative accounting treatments they talked about with management, along with the implications and the firm's preferred approach, and sharing material written communications between the audit firm and management, like, say, a schedule of unadjusted audit differences or the management letter. This ensures the audit committee is fully in the loop on key judgments and potential issues.
This all sounds like a really serious effort to prevent auditors from getting too cozy or tangled up with the companies they audit. Are there also rules about former employees moving between the audit firm and the client? That seems like a potential conflict zone.
Yes, absolutely. That's a significant area they targeted. To ensure independence, the audit firm cannot have employed the issuer's CEO, CFO, controller, chief accounting officer, or anyone really in an equivalent financial oversight position for a one-year period right before the audit.
The cooling off period.
Exactly. That one-year cooling off period is vital. It ensures that individuals moving into key financial roles at a company don't have recent ties to the firm auditing that company. It prevents potential undue influence or, self-review issues where they might be reluctant to question work done by their recent colleagues.
It's clear SOX put auditors under a microscope, but it also fundamentally changed the game for corporate leadership too, didn't it? moving responsibility for financial integrity squarely onto their shoulders. How did SOX Titles 3 and 4 shift that burden and enhance what investors actually see?
Right. This is where SOX really creates more of a shared responsibility framework. It extends far beyond just the auditors. Title III, which focuses on corporate responsibility, places significant new obligations directly on public companies and their senior execs. For instance, public companies are now directly responsible for setting up an audit committee. This committee oversees the appointment, the compensation, and the work of the public accounting firm. The auditor actually reports directly to this committee, not just management. And it's the committee's job to resolve any disputes that pop up between the auditor and management.
So the audit committee becomes the company's internal guardian of audit quality, essentially.
Exactly. And the independence of these audit committee members is crucial. They have to be board directors, but otherwise independent. That means they can't accept compensation from the company for consulting or advisory services, and they can't be an affiliated person who could improperly influence financial decisions. Another vital provision under Title III is the requirement for audit committees to establish confidential whistleblower hotlines. These are procedures for employees to anonymously report complaints about audit, accounting, or internal control issues without fearing retaliation.
That seems important for getting issues surfaced.
Absolutely. It creates a direct and secure channel for concerns to be raised. But perhaps one of the most impactful changes in Title III is the direct personal responsibility placed on the CEO and CFO for financial reports. These top corporate officials must now sign representations on annual and quarterly reports. They literally assert that they've reviewed the report, that it contains no untrue statements or omitted material information, and that the financial statements fairly present the company's financial condition and results.
Wow, so they're not just signing off, they're putting their reputations and potentially their personal finances directly on the line. What else do they have to certify regarding internal controls?
They also take responsibility for internal controls. They have to assert that these controls are designed to ensure material information gets captured and that their effectiveness has been evaluated within 90 days before the report. Their conclusions have to be clearly stated. Furthermore, they must disclose to both the auditors and the audit committee any significant deficiencies or material weaknesses in internal controls. And crucially, any fraud, regardless of materiality, that involves management or employees with significant internal control roles.
Any fraud, even small stuff.
Any fraud involving those key people, yes. They also have to state if there have been any significant changes to internal controls during the reporting period. Title III also makes it flat-out unlawful for any officer, director, or anyone acting under their direction to fraudulently influence, coerce, manipulate, or mislead an independent accountant just to make the financial statements materially misleading. And here's a very strong financial deterrent. If a restatement of financials is required because of material non-compliance, the CEO and CFO might have to reimburse the company for any bonuses, incentive, or equity-based compensation and gains on stock sales they received during that 12-month period.
A clawback, that's serious personal financial risk if things go wrong.
Okay, moving on to Title IV, enhanced financial disclosures. How did SOX ensure investors got a more complete and transparent picture of a company's finances? Right, Title IV really focused on making company financial reporting more transparent and comprehensive. It mandates that all material correcting adjustments identified by the auditor must be reflected in the financial statements. No sweeping things under the rug. Companies also have to disclose all material off-balance sheet transactions. Think operating leases, contingent obligations, relationships with unconsolidated subsidiaries. These are agreements or entities that can significantly impact a company's financial health, but might not appear directly on the main balance sheet.
Those were big issues in some of the scandals, weren't they?
They were indeed. Title IV also requires pro forma financial statements, those as-if scenarios, to conform to specific rules, ensuring they're not misleading and are properly reconciled with GAAP, generally accepted accounting principles. The use of special purpose entities, or SPEs, which were notoriously used by Enron, must also be clearly disclosed now.
Okay, what else in Title IV?
There are also enhanced conflict of interest provisions. Issuers are generally prohibited from making personal loans to directors or executive officers. There are narrow exceptions, but the general rule is no personal loans. Disclosures are also required for transactions involving management and principal stockholders, specifically anyone with more than 10% ownership. This needs to be disclosed at registration when they hit 10%, or if their ownership changes.
And what about Section 404? That's a phrase you hear a lot when people talk about SOX. What makes it so significant?
Section 404. Yes, that's often cited as one of the most impactful and, frankly, sometimes most resource-intensive parts of SOX. It requires that each annual report includes a statement from management. They have to take responsibility for establishing and maintaining adequate internal controls over financial reporting, and they need to include an assessment of how effective those controls were at the end of the fiscal year.
So management assesses their own controls.
Yes, but here's the crucial part. The external auditor must then attest to management's assessment. They provide an independent opinion on the company's internal controls over financial reporting. That external validation is key.
Got it. Auditor checks management's homework on controls.
Pretty much. Furthermore, SOX pushed for greater transparency in corporate governance itself. Issuers have to disclose whether they've adopted a code of conduct for senior authors like the CEO, CFO, or explain why not if they haven't. This code promotes honest conduct, full and fair disclosures, compliance with laws, basically setting an ethical tone at the top. Any changes or waivers to this code have to be reported publicly on a Form 8K.
So everyone knows if they weaken the ethics board.
Right. There's also the requirement that at least one member of the audit committee should be a financial expert, or the issuer must disclose why not. This expert needs specific knowledge understanding GAAP, experience with financial statements, internal controls, audit committee functions. And lastly, the SEC itself is now required to regularly and systematically review issuer disclosures, like the annual 10K reports. They prioritize companies with things like material restatements, significant stock price swings, large market caps, or operations affecting major economic sectors. More eyes on the filings.
This all sounds incredibly rigorous on paper. But what happens if someone deliberately tries to bypass these rules or commit fraud? SOX didn't just set up new systems, it significantly raised the stakes for bad actors, right? It brought down the hammer.
That's absolutely correct. SOX wasn't just about better oversight. It dramatically stiffened the penalties for corporate and criminal fraud. Title 8, for instance, focuses squarely on corporate and criminal fraud accountability. If individuals alter, destroy, or falsify records with the intent to impede an investigation, they face substantial fines and up to 20 years in prison.
20 years just for altering documents.
With intent to impede, yes. For auditors specifically, failing to retain those audit work papers for the required 7 years can result in fines and up to 10 years in prison. The statute of limitations for securities fraud, the time limit for legal action, was also extended. It's now no later than 2 years after the violation is discovered, or 5 years after the violation itself, whichever is earlier. Give prosecutors more time.
So harder to hide evidence and a longer window to pursue cases. And what about those who bravely speak up against fraud? The whistleblowers.
SOX provides crucial whistleblower protection. Employees who lawfully provide evidence of fraud are explicitly protected from retaliation, discharge, demotion, suspension, harassment, you name it. If they are discriminated against, they can file a complaint and may be reinstated, get back pay, and compensatory damages, including legal costs. And for those who knowingly execute or attempt to execute securities fraud, the criminal penalties are severe, substantial fines and up to 25 years imprisonment.
25 years, okay.
And Title IX's white-collar crime penalty enhancements reinforces this even more. It explicitly states that penalties for attempting or conspiring to commit white-collar offenses are now the same as for actually committing the offense. For example, penalties for mail and wire fraud jump significantly, from 5 years up to 20 years. ERISA violations, that's the Employee Retirement Income Security Act, governing benefit plans, also saw fines jump significantly, and prison terms increased from 1 year up to 10 years for individuals.
That's a huge increase in potential jail time. And those vital CEO and CFO certifications we talked about earlier, putting their names on the line. What happens if those certifications turn out to be false?
This is absolutely critical. Those periodic reports filed with the SEC must include written statements signed by the CEO and CFO, asserting full compliance with the Securities Exchange Act and fair presentation of the company's financial condition results. If a party certifies any statement knowing it doesn't comply with all requirements, they face up to a $1,000 fine and/or 10 years in prison.
$1 million in 10 years for knowing.
Yes. And if they willfully certify a non-compliant statement, meaning they knew it was wrong and did it deliberately, that penalty jumps dramatically, up to a $5,000 fine and/or 20 years imprisonment.
$5 million in 20 years. Wow.
It really solidifies their personal responsibility and the severe consequences for misleading investors. No more plausible deniability. Finally, Title 11, Corporate Fraud Accountability, tightens things even further. Tampering with records or impeding an official proceeding now carries fines in Terrador up to 20 years imprisonment, reinforcing the point from Title 8. The SEC was also granted temporary freeze authority. They can petition a federal court to require a company to escrow potential penalty payments in an interest-bearing account for 45 days during an investigation.
So they can stop the money disappearing while they investigate.
Exactly. It's a powerful tool to prevent assets from being dissipated. The SEC can also prohibit individuals from serving as officers or directors of a public company if they've violated securities rules and are deemed unfit. And, importantly, knowingly retaliating against someone providing truthful information to the SEC about a potential federal offense now carries significant fines and Jodor up to 10 years imprisonment, protects informants. SOX truly created a robust framework for accountability.
That's incredibly comprehensive. So SOX was this huge leap forward, clearly. But it's not the only player ensuring auditor independence, is it? You mentioned the SEC earlier. There are other important bodies with their own rules, too.
You've hit on a critical point. While SOX laid a powerful foundation, it really built upon and integrated with existing and evolving independent standards from other key bodies, like the SEC itself, the Government Accountability Office, GAO, and even the Department of Labor, DOL. For example, Rule 201 of the SEC's regulation, SEC, outlines independence rules specifically for auditors of SEC registrants. It incorporates SOX's provisions, but often provides even more detail.
Okay, so the SEC and PCAOB rules work together.
Yes, very much so. They share core principles for what actually impairs independence. They look for situations that, 1, create a mutual or conflicting interest between the auditor and the client, 2, result in the auditor acting essentially as management or an employee of the client, 3, place the auditor in a position of auditing their own prior work, the self-review thread, or 4, place the auditor in a position of being an advocate for the client. These 4 principles are really the bedrock for all the specific independence rules that follow.
And those principles lead to specific no-nos.
Exactly. They guide a non-exhaustive list of specific circumstances that impair independence. Financial relationships are a big one. Any direct investment in an audit client, even a small amount of stock, is generally prohibited for the audit firm or any covered person on the audit team or in a position to influence the audit. This also includes material indirect investments, like owning a significant chunk of a mutual fund that invests heavily in the audit client.
So you have to be careful about your own investments if you're an auditor.
Absolutely. And did you know, for example, that even your checking account balance could technically impair independence if it exceeds the FDIC-insured amount and it's held at an audit client bank?
Seriously. A checking account.
It's about avoiding any perception of financial entanglement that could compromise objectivity. Now, there are, of course, specific exceptions, like for unsolicited gifts or inheritances that you get rid of quickly, or for new engagements where you dispose of any conflicting interest before the audit officially starts. But the general principle is strict separation.
Okay. What about employment ties?
Also tightly regulated. A covered person, someone involved in the audit or influencing it, cannot be employed by the audit client or serve on their board. Simple as that. If a close family member, like a spouse or dependent, holds a key accounting or financial reporting role at the client, that can also impair independence. And then there's that cooling off period we discussed under SOX Title II, which the SEC rules echo. A former audit engagement team member, especially key partners or anyone providing significant service, can't be in a financial oversight role with the client for 1 year before the audit procedures commence for the period following their departure from the firm.
Right. Prevents that immediate jump across the table. What about other potential conflicts beyond direct financial or employment ties, like business deals?
Good question. Any direct or material indirect business relationships between the auditor and the client can also impair independence. You can't be partners in a separate venture, for example. And reiterating SOX's impact, the SEC and PCAOB rules also prohibit providing those specific non-audit services we listed earlier: bookkeeping, financial systems design, internal audit outsourcing, and so on. They also strictly forbid contingent fees. Your fee can't depend on the outcome of the audit or other services that would clearly compromise objectivity. Makes sense. Partner rotation rules are also detailed here. Leading concurring partners typically rotate off after 5 years on the engagement and need a 5-year timeout period before returning to that client. Other audit partners also have rotation requirements, usually 7 years on, 2 years off. There is a small firm exemption, though, recognizing the practicalities for smaller practices. And independence can also be impaired if the audit committee fails its job if it fails to pre-approve services, or if the auditors don't report those required matters to them, like critical accounting policies or alternative treatments discussed with management. And importantly, an audit partner's compensation cannot be based on selling non-audit services to their audit clients. That removes a potential incentive conflict right there.
Okay, so a lot of alignment between SOX and SEC PCAOB rules.
Yes, and the PCAOB has adopted some additional independent standards beyond the baseline SEC rules. These include the responsibility not to knowingly or recklessly contribute to independence violations by others, maintaining independence throughout the entire engagement period, and specifically banning providing tax services related to certain confidential or aggressive tax transactions, ones the IRS might view as potentially abusive tax shelters.
Ah, so not all tax services are okay, even with pre-approval.
Not if they fall into those specific aggressive categories. The PCAOB also prohibits providing any tax services to corporate officers of audit clients or their immediate family members.
Interesting. Targeting the executives personally.
Right. Furthermore, firms have to communicate proposed tax services and any other non-audit services related to internal controls in writing to the audit committee for pre-approval. They have to discuss potential independence effects and document that discussion. And annually, firms must give the audit committee a written communication describing all relationships between the firm and the client that might reasonably be thought to bear on independence, discuss their potential effects, document that discussion, and formally affirm their independence. It's a comprehensive annual check-in.
So if the SEC and PCAOB are focused mainly on public companies and the financial markets, who handles audits for, say, government entities? Do they have their own set of independence rules?
That's where the Government Accountability Office, or GAO, comes in. They issue standards for government audits, known as GAGAS, Generally Accepted Government Auditing Standards, often called the Yellow Book. GAGAS has its own robust set of ethical principles and general standards. Their ethical principles emphasize serving the public interest, integrity, objectivity, proper use of government information and resources, and professional behavior. Objectivity for them explicitly includes independence of mind and appearance, maintaining impartiality, and being free of conflicts of interest. Their general standards cover independence, professional judgment, competence, and quality control, including a requirement for an external peer review every 3 years.
Okay, similar themes, but maybe a slightly different lens for government work.
Exactly. And GAGAS uses a conceptual framework for independence, which is a structured approach to assessing threats. It requires auditors to 1. Identify threats to independence, 2. Evaluate the significance of those threats, and 3. Apply safeguards to eliminate or reduce the threats to an acceptable level. If no safeguards can adequately mitigate a threat, then independence is considered impaired. You can't proceed.
So they identify potential problems and then try to put protections in place. What kind of threats do they typically look for in the government context?
GAGAS identifies several broad categories. A self-interest threat is where the auditor might benefit financially or otherwise from the outcome. A self-review threat is auditing your own or your firm's previous work. A familiarity threat comes from long or close relationships that might make the auditor too trusting or less skeptical. There are also bias threats, where an auditor might be predisposed to a certain viewpoint. Undue influence threats, where external pressures might sway the auditor's judgment, and structural threats, which arise from the audit organization's placement within a government entity, potentially impacting objectivity.
Okay, lots of potential pitfalls.
Yes, but here's a really crucial detail for GAGAS, and it's quite strict: the management participation threat. This threat is considered so significant that no safeguards are considered effective enough to reduce it to an acceptable level.
No safeguards work. What does that mean in practice?
It means an auditor simply cannot take on management responsibilities for the audited entity. They can't set policies, direct employees, make operational decisions, have custody of assets, or basically perform any function that's considered management's job.
Mm.
If an auditor does these things, their independence is inherently impaired under GAGAS, period, because they've effectively become part of the management they're supposed to be independently auditing.
That's a very clear line in the sand.
It is. Examples of safeguards they do allow for other threats include things like consulting an independent third party, involving another audit organization, having a non-team member review the work, or rotating staff, but not for management participation. And all identified threats, safeguards applied, and assessments of management's ability to oversee non-audit services must be clearly documented.
And finally, just to complete the picture, what about the Department of Labor? How do they fit into this complex web, particularly for something like employee retirement plans?
Right, the Department of Labor, or DOL, primarily through ERISA, the Employee Retirement Income Security Act of 1974, sets independence guidelines specifically for auditors of employee benefit plans, pensions, 401ks, that sort of thing. Independence is absolutely required when auditing and issuing an opinion on the financial information for these plans. Protecting beneficiaries' interests is paramount. Impairment situations under DOL rules include any direct financial interest or a material indirect financial interest in the plan or the plan sponsor, the company providing the plan. And the DOL's rules can sometimes be even more restrictive than, say, AICPA rules regarding the period during which such an interest might impair independence. Independence is also impaired if the accountant or firm acts as a promoter, underwriter, investment advisor, voting trustee, director, officer, or employee of the plan or sponsor, or if the firm maintains the financial records for the employee benefit plan itself.
So, similar restrictions to avoid conflicts. Are there any situations where independence isn't impaired under DOL rules? Yes, there are specific carve-outs. For example, if a former officer or employee of the plan or sponsor is now employed by the accounting firm, independence isn't necessarily broken, provided they've completely disassociated from the plan and don't participate in auditing any period that covers their time as an employee there. Or if the firm was engaged by the plan sponsor during the period of the engagement with the employee benefit plan for other services, that doesn't automatically impair independence for the plan audit itself. And if an actuary associated with the accounting firm provided actuarial services to the plan, that generally doesn't impair the audit firm's independence either.
Wow, that was a truly comprehensive deep dive. From the origins of SOX stemming from those major corporate collapses to the really detailed rules governing auditor independence across various agencies like the PCAB, SEC, GAO, and DOL. We've really explored what keeps our financial reporting system hopefully robust. It's definitely a complex web, isn't it? But each thread plays a vital role.
Indeed.
And I think the overarching goal, the key takeaway across all these regulations, SOX, PCAOB, SEC, GAO, DOL, it's fundamentally about safeguarding auditor independence
Yeah.
and ensuring transparency. Ultimately, that protects investors and maintains public trust in our financial markets. What's fascinating, I think, is seeing how these rules are interconnected, how they create these layers of protection, and how they represent this continuous effort to anticipate and prevent fraud. It's all about ensuring the financial numbers you see are as accurate and reliable as possible.
Yeah, absolutely. And the world of finance is constantly evolving, isn't it? With new technologies like AI, complex global transactions. As you think about all the layers of protection we've discussed today, what emerging areas do you think will pose the next big challenge to auditor independence and financial transparency? Something for our listeners to ponder. Thank you so much for joining us on this deep dive. We really appreciate you tuning in. We'll catch you next time.